Okay, so in lesson number 1, we learned about T accounts, and we learned that every single transaction that you do, it has to have one debit and one credit. Okay, so every single transaction has to have one debit, one credit. We also learned that if the two accounts that you're dealing with are on the same side, so if they are both asset accounts or both liability accounts, then one of them is going to be going up in value and the other one's going to be going down in value. But if your transaction involves one asset account and one liability account, or one asset account and one capital account, then they both have to be a plus or they both have to be a minus. So when you're doing these transactions, you have to decide, you can either think of it as, okay, what am I debiting, what am I crediting? You can think of it like that. Or you can think of it as, what am I plussing and minusing, or what am I both plussing, or what am I both minusing? It doesn't matter to me how you wrap your brain around it, but you've got to come at it from one of those standpoints. All we're going to extend to here on lesson 2. On lesson 2, we're going to stay with transactions, we're going to stay with T accounts, but all we're going to expand into is the concept of revenues and expenses. So the only accounts that you dealt with before were asset accounts, liability accounts, and owner's equity accounts. Today, you're going to deal with assets, liabilities, owner's equity, and revenue and expenses. So we're just adding to your accounts list in terms of how to do these transactions. So essentially, revenue is money in. That's what we've got. And expenses is money out. Okay, so revenue is typically your sales, like your product sales. Like if you're running a mechanic shop, it would be clients coming in getting their car fixed, right? That's revenue. If you're running a window washing business, then it's money that you receive from clients when you wash their windows, right? It's sales. Expenses typically are like your monthly expenses, like if you have employees and you're paying wages, or if you have like utilities, like electricity bill, energy bill, that kind of thing. Um, when we think of so assets, remember, are things that you could sell. Expenses are like bills. There's nothing to sell, right? So it's not like, for example, if you need to buy yourself a new laptop to run your computer, that's not an expense, that's an asset. Because buying that computer could be turned around later and sold to make you some money. Okay, whereas expenses is just money out. There's nothing to show for it. Okay, so revenue is coming in, and then now the sales at the same time, expenses increase. So the owner now has to pay expenses such as employees' wages, rent, utilities, supplies, stock, that. If this business is successful, revenue has to be bigger than expenses. So if the revenue is bigger than the expenses, we call that a profit. Okay? If the revenue is smaller, then we call that a loss. And if you keep running in the loss category, in other words, if you're spending more than you're making, then you're going to go out of business. Okay? That's why on a month-to-month basis, we want to make sure that we're always checking our accounts, we're checking our balance sheet to make sure that the asset side is always bigger than the other sides. Now again, we're doing this by paper pencil, we're doing this manually. When you run a business, you're going to have accounting software running in the background, and that accounting software will be constantly updating and constantly checking to make sure that you're doing things like that. Okay, so a couple of things here. So we paid attention to assets, liabilities, and capital. So again, for assets, debit, credit is plus minus. For liabilities and for capital, it's the opposite. So they both have debit on the left and credit on the right, but for assets, the debit is the plus, and for liabilities and capital, credit is the plus. Okay? And then finally, capital is the money that the owner personally invests in the company. Okay? When you get going into actually, if you do choose to take an accounting degree, One of the words that you might hear is company dividends. Dividends are essentially a wage that the owner of the company pays himself. So let's say the company makes $20,000 in profit last month. The owner pays himself $10,000 in dividends. So that would be he takes the profit from the company and pays himself a wage. And then the extra 10,000 left over, he usually reinvests it back into the company to make it grow and do more things. Okay? So, what we're going to do now is we're going to do T accounts with our temporary accounts. So, why are they called temporary? So, permanent accounts are your assets, liabilities, and capital. Those accounts are always there. Even when they have a zero balance, that you will always have assets, you will always have liabilities, and you will always have owner investment. Okay? Really, really successful businesses are businesses that have way more assets than liabilities. Okay? However, you should always have some liabilities. Liabilities are a sign that you are investing in your company to make it grow. I'm going to use a farming example. A lot of farmers, they can run their farm and not buy new equipment for 20 years. But when everything breaks, it all breaks at the same time. So you don't want to have to be buying a tractor, a combine, a truck, all that stuff in the same year. You want to do it like every 5 years, you want to buy something new so that you're constantly investing in your operation to constantly keep making more and more money. So that is a liability, right? When you're spending money on that equipment, because most people aren't buying it outright because they're stupid expensive, but you're still investing in your company. Businesses are the same thing, right? You constantly want to be investing in your own company by purchasing things, whether it's on credit or loan, so that you can make your business grow. Okay. The temporary accounts, called income summary, drawings, revenue, and expenses. The reason why they're called temporary is because what you do is you close them off, or in other words, you give them a zero balance at the end of each accounting cycle. So that way, let's say every 6 months, you close out your accounts. So you can clearly see at the end of 6 months, have you made more than you have lost? Is your revenue higher than your expenses? All that fun stuff. So it allows you to kind of wipe the slate clean every 6 months, so you kind of get a wage and a gauge for how things are progressing. So just to go through this with you and just explain to you. So again, revenue is money in from sales. Expenses is money out. For example, bills, wages, utilities, that kind of thing. Drawings, what drawings are, ooh, let me see if I remember this. Drawings is the owner takes out money for a personal expense. So for example, he knows his business is turning a profit. So he's like, okay, my wife is bugging me. She's really wants a weekend away, but I don't want to rack up the MasterCard and pay interest rate. I'm just going to take money out of the company and pay for my weekend away. That would be a drawings. So the owner takes profit from the company and uses it to buy him something else. So instead of giving himself a wage, he takes it out of drawings. Now, why would you do that? Because when you pull a wage, it's taxable. When you do a drawings, it's like a sleight of hand. You're just pulling money out of the company. Hopefully nobody pays attention and you're good to go. You're just changing the bottom line of the company. You're just changing how much profit the company made that month. Where some bosses get into trouble is they pull out too much in drawings to the point now where they're not making a profit anymore. Okay. Income summary. We're not going to worry about this till FinMan 1030. We don't do anything with the income summary account. Excuse me. But what it is, it's a summary account that shows whether you made a profit or a loss. So it's done usually like once a year or once every accounting cycle. So maybe once a month, every 6 months, whatever. And it just shows if that company made a profit or a loss for that. It's literally, it summarizes what your income was. It's literally, it's the name sounds. We are not going to do any transactions in income summary. We're not going to use income summary till 10:30, but it will appear on your T accounts. So I just wanted to go through that with you. Now, here's where we're, excuse me, here's where we're going. So at the end of each fiscal period, whether it's monthly, semi-annually, or annually, the amounts in these accounts will be transferred to the capital account. So this is what's called closing entries. And we will deal with that in a future lesson because we always want to close these accounts off to give them a zero balance. Okay. And the reason why we're doing that is that if you keep pulling a loss, like if your expenses keep exceeding your revenue, when you close it off, your capital account, so if your expenses are higher than revenue, your capital account will go down because as the owner, you're having to put more and more money in to keep the business afloat. So your capital account's going to go down. But if your business is making money, then your capital account's going to go up. So by closing off these accounts, we can see how the capital account goes up and down, and it kind of gives you an idea as to the health of your company. That's the gist of it. But for today, we're just going to focus on just doing these transactions. So we've talked about Gurpeet's snow removal company. So just to remind you what his accounts are, he's got 3 asset accounts. He's got his checking account, he's got a snow blower, and he's got shoveling equipment. For his liabilities, he has a loan to his parents as well as a regular bank loan. Owner's equity, so there's your capital. So that's what he, Gurpeet, has invested into his account. And then here is what we call the temporary accounts. So we've got drawings and income summary. We've got his sales, so that's the customers that he's doing snow removal for. And then he's got 3 expenses. So he's got his snowblower expense, he's got a truck that he pays expenses on, and he's got other miscellaneous expenses. Those are his accounts. Okay? So asset accounts, debit, credit. Debit will be the plus, credit will be the minus. Liability accounts, credit will be the plus, debit will be the minus. For the capital accounts, so let me make sure I have this right. Okay, so the capital account, this is on the next page. Credit is plus, debit is minus. For the drawings account, the debit is plus and the credit is minus. The reason these are opposites, so the capital account and the drawings account are opposites, because think about it. Capital is the money the owner invests in the company. Drawings is the account that the owner of the company takes out. It's the money the owner takes out of the company. So this is the owner putting in money. This is the owner taking out money. They're opposites. They work against each other. So their debits and credits have to be opposite. Okay. We're not going to worry about income summary because, like I said, we're not going to deal with income summary until the very end. So we'll deal with that then. Sales or revenue. Sales are credit is plus, debit is minus. And expenses, debit is plus, credit is minus. And again, these are opposites because expenses are the opposite of money out, money in. Right? So money in is the opposite of money out. So their debits and credits are backwards. So what we've got now is these partnerings. Okay? So last week, I gave you this sheet. So if you flip the page in the notes, I gave you this handout. And I gave you a little plastic sheet to put it in. And it had these extra accounts on there. So in lesson 1, we only use the top 3. Now we're going to be using all 6. So again, you don't have to have this memorized, but what you may want to have is either these notes beside you or that pull-out sheet beside you, so you can see what is being debited versus what is being credited. Okay? So all we're going to do is just a bunch of examples. Now, after you've gone through and done all your transactions, remember the balance of the debit should equal the balance of the credit. So other thing, asset, balance is on the debit side. Liabilities, balance is on the credit side. Capital, balance is on the credit side. Expenses, balance is on the debit. Revenue, balance is on the credit. Drawings, balance is on the debit. So here is where I thought maybe you'd want to use highlighters. So assets, expenses, and drawings all work the same way. Liabilities, capital, and revenue all work the same way. So by putting two colors to it, maybe you can start seeing the debit versus the credit or the plus versus the minus. Again, my goal with you in this course is not to get you to memorize this. There are no tests in this course. I just want you to understand what you're doing. Okay? We're not talking about memorization here. Okay. So, so we're just going to do some practice here. So I apologize for the small type. I was just trying to get it all on one page so you didn't have to do a whole bunch of back and forth. But in hindsight, it came out written so small. I don't know if that was a smart move. So, but my reason for this was this. So first things first, you need your chart of accounts. Okay? So we just established that assets, expenses, and drawings all follow the same formula. Okay, so assets, drawings, and expenses all follow the same formula. So assets, okay, drawings, and expenses all follow the same rule that the balance goes here, debit is plus, credit is minus. Okay. My liabilities, capital, and revenue all follow the same formula. So accounts payable, capital, ignore that, and revenue all follow the this is plus, this is minus, and the balance goes on that side. Okay? So what we have to do first is take the balances off of the balance sheet and put them into the correct T account. So, it's a little loud. So let's see if my old eyes can see this. So cash is 2106.31. So 2106.31. Accounts receivable 1200. Studio equipment 45,000. Mobile equipment 27,000. And again, these are all the opening balances, so you're putting them on the balance side. Office furnishings 35.75. Other thing, don't put dollar signs in, but do put the cents. Okay. Okay, liabilities. So accounts payable 24,500 on the balance side. Bank loan 30,000. On the balance side, capital 24,381.31. Okay. Now, you'll notice that drawings, expenses, revenue will always start at 0. Because remember, we're closing these accounts out at the end of each cycle so that we always start at 0. Always. So that's kind of what we learned about last week, okay, except for the revenue and the expense accounts. But assets, liabilities, loans, equity is just a full-on review. Are we still happy? So like I said, don't worry about income summary for now. Just ignore it. Lastly, accounts receivable are people that owe you money. Accounts payable are people that you owe money to, right? This is money coming in. This is money going out, right? Assets is in, liabilities is out. Revenue is in, expenses is out. Okay, so we got some transactions here. So I don't know if you can read yours or not, because again, stupid me thought, yes, let's make it as small as possible. Okay, so transaction number 1, paid $500 for amount owed to the bank. Now you will notice that most of your transactions, I would say 80 to 90% of your transactions will involve the cash account or the bank account, the asset cash, okay? Because you're paying money into and out of it. So you paid $500 amount owed to the bank. So your cash is going to go down, right? So I always try to figure out one of the two accounts and then I'll know what to do for the other one. So cash is going to get credited $500. And this is transaction number 1. So remember, every transaction has to have a debit and a credit. So I'm crediting cash. So that must mean then that my bank loan is going to get debited 500, right? Because remember, debit, credit. Okay. Received $3,000 from advertising sales. Okay, this is revenue. So think about it. $3,000 came into the company. So this means that your cash is going to go up by $3,000, right? Because it's money that came in. So cash is going to get debited 3,000, which means then that revenue, right? Debit, credit, revenue will get credited 3,000. But again, for the green accounts, the credit is the plus. So this gets plussed and this gets plussed because you're on opposite sides of the equation. Okay. By color coding it, you can clearly see. Like with the first one, right? I've got credit and debit. This one's being minused, right? Okay. Next one. Oh, this was number 2. Okay, number 3. Paid $1,500 to accounts payable. So this means then that your cash is going to go down. So cash, whoops, gets credited $1,500. So if cash is getting credited, that must mean that accounts payable is getting debited. Right? You need one credit and one debit for each and every transaction. Received $2,500 from advertising sales. Again, this is your revenue. So cash is going up. So cash is going to go up 2,500. And revenue, so debit cash, so credit revenue 2,500. Is this making sense? You get better at this the more you do them, just like most things in math. Okay, paid 500 to fix some equipment. So this means then that your cash is going to go down. So let's just do that part first. So cash is going to get credited, 500. Okay. So right here is your equipment expense. So you paid to have it fixed. That's an expense, right? It's money out. So if I have credited cash, that means then that I have to debit equipment, right? For every credit, there's a matching debit because I paid cash to fix it. Paid $850 for rent. Again, expense, cash is going to go down. So I'm just, instead of keep going up and down, cash, I'm going to credit, rent expense, I'm going to debit. Received $1,000. So my cash is going to go up. So cash gets debited. So then that means then accounts receivable has to be credited. Okay. Okay. Sold old studio equipment and received $20,000 cash. So first things first, you received money. So your cash is going to go up. So it's going to get debited. Now, studio equipment is an asset. Studio equipment is an asset. You sold $20,000 worth of equipment. So now you've decreased the value of that asset. So you're going to put the 20,000 on this side. You are going to credit studio equipment. Because it has to go down, right? You don't have as much of an asset anymore because you sold a bunch of stuff. Now maybe you sold it so you can buy new, but right now your assets have been decreased. You purchased a new desk. So we're going to assume you paid cash because it didn't tell you that it put it on account. If it says you charged it, then that would be an accounts payable because you put it on a credit card. But when it just says you purchased, that means you use cash. So cash went down. You used $500 to buy cash. You purchased a new desk. New desk is office furnishings. So office furnishings, now you have an extra asset, right? You have more good things. So office furnishings is going to go up, meaning it's going to be debited, right? Credit and debit. Last one, same as before, you received $2,000 from advertising sales. So your cash went up, so it gets debited. So your revenue account is going to get credited. Is that becoming easier? Okay. So what you would then do after that, in the second stage of this, is once we would have all of them recorded, you would then figure out your new balance, putting it on the correct side. And then you would make sure that all of your yellow accounts balance and all of your green account balance ended up being the same number, right? So what you would do at the end is that your yellow balance would have to equal your green balance. Okay, so all of your yellow balances would have to equal all of your green balances. Okay, and if they don't, you know you've screwed up. That's where I come in and try to rescue you. Do you have any questions on that? Okay, so that's the full workup of all the answers. Okay. Okay, so my question to you is this. Do you want to do another practice? Or do you think you want to attack the assignment? Assignment? Okay, so skip over that next page. So the assignment, I did put the assignment over. Now, if you wanted to, if you felt like you needed to do the extra practice, I do have the answer as a slide and I can show it to you if you want. But if you wanted to work on the assignment. So for the assignment, so the T accounts are on the back. What I have done is I have given you just enough squares to fill it. So if you end up with an extra number, but you ran out of squares, you've done something wrong. So I've given you, so like for the cash account, this is how many squares you should be using. Okay. For the next account, this is how many squares. So when you're filling it in, please go down the page. So what are your accounts here? So your accounts are cash, delivery equipment, office equipment. So you're going to go cash, delivery equipment, office equipment. And then you've got liability, accounts payable, XL Motors. And then you've got H. Orton Capital. And then H. Orton Drawings. Hold on, 1, 2, 3, 4. 1, 2, 3, 4. Yeah, and so don't do the income summary account. Skip over that. You've got delivery revenue. Then you've got advertising expense, delivery truck expense, and telephone expense. Okay. If you're using colors, so accounts receivable and what was it again? Accounts receivable, expenses, and drawings are all plus minus. And your liabilities, capital, and revenue are all minus plus. So what you're going to do for this assignment, start off by recording the opening balances just for the assets, liabilities, and capital. So you're going to start out with the balance. But remember, this one starts with 0, and all of those start with 0. And drawings also starts with 0. Okay, so put the balances from the balance sheet. And then underneath them, I've given you a bunch of transactions to do. Now, if those transactions are too hard to read, I've got it nice and big up on my board here. So I'm going to show you the next slide with the transactions. And if you want to take your phone and take a picture of it, and then that way it should be good to go. So if I just go ahead to the next slide, I'll come back to this. If you want to, well, where is it? Here it is. Nope. There it is. If you wanted to take a picture of that with your phone to make it a little bit easier to read, you can come on up here so that way you're not having to zoom in as much. Maybe that's easier than trying to read what I have here in small. I didn't realize it was going to print it out this small, guys. I'm sorry. But this is just a paper pencil assignment. There's nothing on Google Classroom. There's nothing on okay. So take a picture of the transactions. They are written in your book, but like I said, they're small. So all you're doing is filling in the chart on the very back page. That's it. And then you're going to hand this in to me. That's your assignment. So we're going to stay in the classroom tomorrow. So tomorrow, just come here. You're working on this assignment. You're welcome to leave early when you're done. Okay, you don't have to stick around for the full 45 if you get it done quickly enough. And then on Wednesday, we'll start in on a new concept. Okay? Okay. Let me just shrink this down. Just give me one sec.